what I'd like to do today is to replicate someone else's work. Okay. The good researchers, well, they ask interesting questions and try to provide some answers to those questions. In doing so, in many cases, you need to support your argument by conducting some kind of empirical research. Okay? Well, the capability of producing some output, well, you have to learn it by hand, particularly by practicing replication of someone else's work. Several times, you quickly you develop your skill, and then later on, somehow you can combine those tools to produce some meaningful output. Okay, so let me go through the issue of estimating asset value, and I show you, how to follow someone else's paper to produce output in an exact way. The question here, if you look at balance sheet, left-hand side is asset, right? Right-hand side, you have liability. This is debt. Okay? And there is an equity if particular company is listed in the market. Okay? As you know, equity, stocks are traded every day, right? So the current value is constantly updated, right? On the other hand, debt, if you borrow, let's say, 100 billion once, and that's the value of liability on the book. Because this is not traded actively, so it is not priced. So market price of this debt may be different from 100. Because this is not priced every day, you don't know this one, right? So in somehow, if you can value this one real time, then adding these two, obviously you get the value of this one, right? The method we'll be looking at today is to estimate this one. And this is one illustration. Particular company, Hyundai Heavy Industry, it's their asset value over time. Okay. Estimated using the method we'll be learning today. Okay. Why estimating the market value of asset is interesting? Well, suppose you're looking at a particular bank. Okay. This is Bank A, and there could be Bank B. Right? It is their debt, okay, liability. Well, if their asset fall below liability, then there is an economic incentive to go bankrupt. Right? So, in somehow, suppose you are at T. Suppose you are a regulator. Okay? You can simulate Bank A's asset value into the future. Well, if you are given, let's say, this data, then you might simulate this one, right? Or this one. So you simulate this, and Bank A has a liability up to some level, like this one. So we can see whether there's a chance that this may fall below this level. Okay. There's another bank, right? Different level of liability and different asset value, and you can simulate that. Okay. Obviously, in a banking industry, bank A and B may be correlated. So we consider correlation and simulate asset value and see if what is the chance that several big banks may go bankruptcy. Okay. So if there is a chance that those banks go bankruptcy at the same time, then obviously you have to do something, right? So that they could adjust their portfolio or this portfolio, right? So seeing this one is interesting. Also, using this concept, which will be discussed shortly, you can actually calculate the probability of this particular company going bankruptcy, the probability. And the information is coming from stock market. Okay. I don't know whether showing this data is okay or not, but just I show you and you see, this document is one of the reports I've read recently at the risk management committee of a particular company, and you see this one, expected default frequency. So, they provide insurance service to those exporters or importers, okay? And they observe those companies, and they could place particular deal as caution or some other category like that. And one way to do it is to calculate the probability of default using this information and liability information, and monitor that. And if that level rises by such, then they intervene and they probably lower the limit to the limit of insurance coverage. Okay. So these are actually used in actually real companies. So looking at this problem may be interesting. So let me come back to this these two slides later, but this is the idea. Okay, now the situation is you are at time 0, so this is today, okay? And let's say this is value of asset. Of course, as I said, well, because of this accounting identity, you can calculate always some number, right? But as I said, that's a book value, not market value, right? But there could be something that reflects real market value for asset. Let's call it V. Okay? V. And the line here, this one, is a liability. So usually liability is defined as there is short-term debt Also, there is a long-term debt. This one, the maturity arriving less than a year. This one, longer than a year. Okay. So usually, when you set this kind of default level, usually full of this and about half of this one. Many companies actually have most of debt in terms of short-term debt, not much long-term debt. Okay. So usually short-term debt plus half the size of long-term debt, that's usually the default line. Okay. So if value grows, value of a company grows, then obviously over this horizon, there is no problem, right? But if it falls below there, then there is incentive to go bankrupt. Okay? In this particular case, if you start from this value of V0, then somehow you can make appropriate assumption about the process for VT over time. And the ending point could be, somewhere here on average, and optimistically some level like this one, pessimistically some level like this one, right? And some distribution. You can think of some distribution, right? So here, the expected default frequency, you can think of this one as just a probability of default of this particular company, is defined as this area. So if value of asset is expected to go most of the time this way, the whole distribution shifts down, right? So the area will be increasing. So the report I shown a moment ago is to look at this distribution, see if whether a particular company, this distribution falls, okay, or improve. Then obviously this quantity depends upon whether this value of asset grows on average with rate 0, so flat, or it grow positive, or grow negative, right? So projection is very important, right? But we don't observe this one. That's one problem. The second problem is, in addition to the unobservability of this VT, also it's difficult to assess whether this will grow positive or flat, or even negative. Right? So that's important parameter. So we try to estimate the growth rate of this VT along with VT itself. Okay? What else? Well, if VT is not that volatile, then ending point could be very narrow, right? Distribution could be very narrow. If volatility is big, then this distribution is wider, right? It's making this area bigger, right? So the growth rate as well as volatility, those are two important parameters we want to estimate along with VT. Okay. So that's the task. Okay. Usually, we set this horizon as 1 year. 1 year. If you assume that VT, this asset value, is distributed normal, we can actually calculate or derive the formula for this area, okay, where this is a cumulative density function of standard normal, this pi, and natural log. And this x is the default line, this one. This one. And this one is obviously coming from this side, right? So this is accounting data, right? Accounting data. R is risk-free rate, so we can observe it, right? And T is set equal to 1 year, so it is 1. Okay? 1, 1. And the sigma is the volatility of VT. Okay? So we need to know V and sigma. Then we can calculate this quantity, and that's the probability of default. Okay? So how to calculate V? Here is one approach. Actually, the way people value this one, theoretically, is to use well-known Black-Scholes option formula. Right? So, the company with this capital, they can decide when to go default. So they look at this one and their asset, and they can determine when to close a company. And then what is the option value? So we can think of a company going bankrupt. That's the option. You can exercise that option, right? What is the value of that option? Well, it says this is value of equity, which is number of shares outstanding multiplied by current stock price. That's the value of equity, this one. So you can get this data always. And VA is the one we don't know. We are interested in estimating. This is a cumulative density function of standard normal distribution. D1 is defined here. Okay. And this is strike price in option formula. But in our case, the strike price is this one. So if it goes below there, then you exercise your option. Right? So situation is very similar. And this is a probability sort of thing, which is defined here. D2 is defined this minus that. Okay? And this value is discounted back. Okay? So you probably see that this one in original Black-Scholes formula, this is price of option. So let's say call. Okay? This is underlying assets value. So if option is written on, let's say, Kospi 200, then current Kospi 200 is this one, which is observable, right? Observable. And this is strike price. But in our case, this underlying asset price is not observable. Right? So we try to estimate this one. Now, well, as I said, there are several things observable, or we can assume observable X, observable risk-free rate, and time, 1 year, right? But we don't know we don't observe this sigma A as well as this one, VA, right? So in this case, market value of company, equity value of company is observable. So this is observable. And on this side, we have two unknowns, right? Two unknowns. One, this one, the other, sigma. So one equation, two unknowns, you can't solve it, right? So what people did actually, is to take first derivative of this one and derive the second equation like this one, where you have sigma E is the volatility of equity value of company. So if you have this data from the market, then you can calculate sigma E, right? Volatility. So this is known, and of course this is known, unknown, unknown, right? So if you solve these two equations, two unknowns, right? So you can solve it for V and sigma, this sigma. So that's one approach. Okay? So this is the illustration of expected default frequency of Korean savings banking industry. So currently, some of them are out of business, right? Already out of business. And some good time and some risky position over the period. And then this is global financial crisis period. Here, if you read it, this is 5%, this is 10%. If you look at large banks, not a savings bank, usually the probability of default could be like 5 basis points or 3 basis points. Very small number. But these are quite big, right? So if you are actually a regulator, you can monitor this one and you can read which one is this. As long as those companies are listed, so that as long as this information is available, then we can calculate this one. So there are several security companies are listed, banks are listed. Of course, not bank. The financial group itself is now listed. So Financial Supervisory Service or Korea Deposit Insurance Corporation, they have some sort of system like this one so that they can monitor this one constantly. Time series plots are usually deceiving. Sometimes it could be misleading, depend upon the way you present it. If you draw a whole period with this one, this may appear to be, this may look, relatively better, right? But if you just look at this period only, then maybe you may have some different view about this industry, right? Very different look. Okay, so the one I introduced here is to estimate VA sigma A by solving two nonlinear equations. Okay. So you can calculate it. So using some data over, let's say, last 24 months or 36 months data, you can collect first stock price times number of stocks outstanding. That's the market capitalization, right? So collect this data and check whether this is non-stationary, usually non-stationary, because firm grows over time, right? Because of this stock prices non-stationary. Then you can calculate log difference and calculate standard deviation, right? Standard deviation. If you use previous data, and that's this one, right? Along with this market cap right there. Okay? And read off company's debt figure, and that's your data X. Collect currently available risk-free rate, then you are ready to solve this system, right? So using some window, you can calculate VA sigma A today. Okay. Then next month, we look at the same window and collect this one. So you can keep doing this one, right? And you can trace the plot of VA. That's the graph you've seen. Here. But this one in particular is not calculated using that method. We use alternative method. Here, Luhar's paper, a very nice, decent journal, where they assume that VT, a value of asset, is described by this process, geometric Brownian motion. So this mu is determining the trend of V, growth rate, and sigma is volatility. Okay. And this is Z is Wiener process. Then this one is a formula we've seen previously. Value of equity equals to this unknown, and pi there, and this one. B of small t, in this case, B of small t instead of this one. So it's like X is the value at the terminal date, let's say 1 year from now, okay? That is discounted back by this one, right? So this is current value. So every detail counts because you have to solve this one in somehow. So the way Black-Scholes formulate this problem here is to write it this way, but Luhar chose this expression. So you don't see risk-free rate, right? Discounting factor. So cap t is terminal time, current t, small t is now, right? So this is current value, right? But other than that, this formula is exactly the same as the previous one, okay, Black-Scholes formula. Then the question is, well, how to estimate this V, sigma, and this mu, hopefully, is to evaluate this one. This is log likelihood function of what? This equity. So the way so here the M is the window, size of window. If you set window as 24 months, M equals to 24. Okay. And this is the parameter we want to estimate, so this is unknown. Okay, unknown. And well, you probably have some idea. Well, as long as you can write your likelihood function in some closed form with given data, and as long as you identify what are the parameters to be estimated, then you write this one as a function, give initial values, and then you can maximize it, right? Or negative of that could be minimized, right? So writing likelihood function is all it takes. But the thing is, well, we don't have data, V. This is something you want to estimate, but it looks like likelihood function is set up in terms of something unknown. Right? So how to make this process, estimation process, feasible? That's the task. Okay? So let's go back to Lehar's paper. And see if what is his explanation. Okay, so he starts with this one. He says, this is assumption, right? The asset value V of the bank follows a geometric Brownian motion. This one, okay. B is the future notional value of the bank's debt. And maturity is T, so this formula, okay? And then it says, given sequence of market cap, this equation 1, because we know that this one is normally distributed, right? So this one is also normally distributed. So normality is used to derive this function, likelihood function. Okay. When you read someone else's paper like this one, well, here is a rule. There is something here. When someone read this paper for the first time, then they probably remember Black-Scholes formula, where they see something like this one, B of T. Okay. But this author used B small t. Right? So actually, if you divide both sides by ERT, then B of t is this, and then discounted back, right? Discounted value. So the same thing, right? But if you don't explain this one explicitly, and people will wonder, right? Why? Where did this term? Where is this term, right? So if this is critical in implementing this type of method, then you should bring it to the main text. Because usually we don't care much about this one. This is just for your reference, right? Footnote, right? You can read it or you can skip it. But if you skip this one, then probably you may be puzzled about why there's notation change. Right? So, good habit is if you think something is absolutely important in this problem, then I have to bring it to the main text. Okay. And those, well, you can say, well, this problem may be sensitive to the choice of this m or the scaling of sigma. That's sort of something technical, right? If you think that could save those researchers' time in replicating their work, then they probably they share their experience in this footnote. For that's very kind gesture. But other than that, usually having long list of footnote is not a good habit, I think. That's what I learned from my teacher. Okay, now then, here, because V is not observed, here is explanation about what V is. Where V hat is a solution of equation 2, previous equation. Okay? With respect to a V, and D, of course, is in equation 3. So what it says is, for each month in the sample period, the parameters of the assay process mu and sigma are estimated by assuming the maturity of that t being equal to 1 year. So here is something clear, statement about maturity. And using a rolling window, and it says it is set to 24. And then for a given month, I estimate the parameters, 2 parameters, using the last known level of debt and the last 24 observed market values of equity. So it says, the debt is borrowed from this information, right? What is the frequency of information, disclosure of this type of information? Quarterly, maybe semi-annually, or annual, right? So this debt information, well, if this balance sheet is available every quarter, then the level could be constant over 3 months, right? And then it could jump and then stay, right? And maybe falling, right? And then stay. So that's what this description means, using the last known level of debt. Okay. Then I roll the estimation window forward by 1 month. So what, in summary, if you have an initial guess on mu and sigma, you can solve this one to calculate V. Right? And using that, you replace this part. Right? So if you are evaluating different combination and different V's and different likelihood value, right? So you change the combination many times and make and try to find something that maximizes this function. But while you do this, you have to first calculate this one using solving this one, and then this. So we'll take a look at the program. The data looked like this. So first, these are dates. The next one, let's see, where is the description? The data, the first one is the month indicator. The second one is market cap. And the third one is risk-free rate. The fourth one is this part. The last column is this part. So I read these two and add half of this to this one. Okay. Of course, when you read this data, market cap, the unit has to be the same, right? Unit has to be same. So data looks like this. Okay. Monthly data, of course. This particular data is for Hyundai heavy industry. I have initial value for V here. Okay. Because original data has very is expressed, I think, is in 1,000 something. So you want to shrink this one by dividing the data by this much, okay, and make interest rate as a decimal. Okay. Okay, these two are initial guesses for mu and sigma. Okay. Then we start from M, because we'll be looking at past 24 months to start calculation. So we start from here until the end of observation, and moving window is each updated. It's rolled every month. Okay. Then I save calculated value Vt in this vector. So I try to calculate 24 numbers of Vt. And I try to calculate Bt as well. And then reading data from the start to 24, 1 to 24, first data. Okay. Then next, you are rolling. So this is the data. Okay. Here is a likelihood function, and these two are the parameters, converging estimate. In Gauss, in this case, if you can set, actually you can select particular algorithm to minimize objective function. So this is very popular method. So probably you use either this one or this one, but my preference is this. Okay. when you calculate V, when you calculate, when you actually minimize this objective function and find converging estimate for mu and sigma, if you want to transform the original data to make something always positive or something like that, you can transform it again, and then this one will contain one mu and sigma, right? So plug it in. This is mu. This is first one is mu. Second one is sigma. So sigma squared. Okay? So this is the one minus this whole thing, and we plug into cumulative density function of standard normal distribution, and that will give you EDF. Okay. And in the output, I try to have as many information so that I can later read off, for instance, this EDF from here. Okay. Now, so inside this likelihood function, let's see this trans function first. I try to make standard deviation always positive. So if you read something, the second one is squared. So this B02 could be negative, but in my program, objective function, this is my sigma. Okay, so it should work. Okay. Okay, here, 1 through m, right? 1 through m. See, here 1 through m, right? Here, BT is short-term debt is the first column, and weight is about 0.5, and this one is long-term debt. Okay? And the second column was market cap. And this BT is strike price. And this is interest rate. The reason why I brought this notation is to use this function. Where you put market cap, initial value of V, initial value, and this is default point, interest rate. We don't have any dividend. The tau is 1 year. Okay. And the volatility, V is, this one is sigma. Okay. The reason why I have this is, actually, this function is not mine. It's someone else's function. All I know is how to use it. Okay. The way that this routine is set up is quite complicated, right? Looks complicated, this function. But one of my research assistants looked at the program where, if this is call option, you have call option price, you can read it from newspaper, right? So this is the data. And this could be Kospi 200. You can read other information like strike price. So if you plug in those numbers, then what is left with is one unknown, which is sigma. So if you have call option data, then you can calculate the sigma. That's what we call implied volatility. Implied volatility. So if option, the maturity is, let's say, is 1 month, then the sigma you can calculate as an implied volatility is the market's consensus on the average volatility between now and up to 1 month. So if call has maturity, let's say 3 months, then the sigma you can calculate is the average volatility over the next 3 months. VIX, Korean Volatility Index, I've shown to in the first half of this semester. That's the volatility over the next 22 trading days. So about 30 calendar days. So what they do is they collect those transaction data, call option or put option, and you can calculate many sigmas for different maturities, right? And somehow they draw some volatility term structure. So this is maturity and this is volatility. So you can read off 22 days. That's the volatility index they calculate. So the routine I used in this Gauss code is to borrow someone's a program that receives as many information, and then either it can calculate sigma, if sigma is unknown, or if you put sigma and you can let this one can be computed as unknown. So one of the programming tips I mentioned previously is before you write your own code, try to ask around and see if there is something already written and tested, and try to use that first. Okay. So I just call this function and calculate V. And then this is dt in our notation. So when you calculate V and D, you can plug in D here, V there, V and slack. And of course, this is your initial guess, and this is another initial guess. So this value is defined, and it will be continued, add. Right. So this is your likely function. Okay. So I followed exactly what they described to calculate this. Let's see. So let's try this program. So this is the data, obviously monthly data, right? And this is market cap, interest rate, risk-free rate, and short-term debt, long-term debt. You know, if you compare the size of this, most of the debt belongs to this one, this category, right? So even big companies can go bankrupt because they carry a lot of short-term debt. So if market is squeezed and credit is very tight, then even that big company could go anytime. Okay. So when everything is done properly, I can see this. So when you calculate likelihood function using 24 observations, so you first calculate VT and then likelihood function. Okay, so you calculate a VT sequence up to current period using initial guess on mu and sigma. Okay, so when mu and sigma converge, then the last VT is saved because I want to trace that value, right? So I store that, and this is a default point, and the last data is EDF. Okay. Okay, let's try to run it. So we'll do many iterations because we are rolling every month, right? So it's two-parameter problem. This is value asset, market value of asset, and this one is, I think that's a default line. The last one was 7th column, so that's EDF. There has been some period of very big value, but very a safe company. So this is but even in this period, still, this is 0.5%. 0.5%. Let's see. I believe the sixth one is, this is market cap over time. But I don't know why EDF calculates so big in this period, but we don't see that. Okay, so if you calculate EDF, you can monitor that over time. Also, so this is the liability over time, and that's value of asset, and this line is market cap, right? Some other companies compared, and below, in the heavy industry, their mu, growth rate of asset value, is this yellow one. There are some periods, when asset grows very fast in this period, right? Both company. This is Hyundai heavy industry and Doosan heavy industry. But when things go wrong, difficult time during global financial crisis period, and some company grows back, the others not. So if you are owner of particular group, then this will make you concerned. Right? You are looking at yourself, and also you need to calculate the other, the competitor. Okay? So one of the motivation of this type of study was why particular company is not growing as fast compared to their competitor, and what determines this one. Sigma volatility is much less, right? So if you actually go out there and look at stock price of this company and this particular company as a comparison, then they have more stable sigma and potential, more growth, right? So it's very difficult to narrow this kind of gap. So you can use this kind of output for that purpose to evaluate growth potential of your company, current position, comparing with your competitor. Also, if you're a regulator, again, then these information could be used to derive some kind of simulation tool to see if whether our shipping industry is sound or expected to go. Shipping industry these days perhaps have all negative value, I think. But it's a very simple thing. Collect those 5 columns data and plug it in, and it'll tell you right away this information. So one of if you are, if you joined internship, for instance, this is kind of work those institution expects from you. You can advertise yourself. I can do this, do that. Okay. Then for 1 month or 2 months, you can write a small program, so that of course you can ask your team to help you. Let's say to bring me data in this format up to here. Then my module enters right there, and then output is automated. If you want to see it every time, you don't do that. You don't want to do it, manually every time, right? You can make it some kind of operating system. So, that kind of capability is something, they value very much. And for the last 4 years of internship program, we have been very successful in that regard. Simply, code is not that lengthy, but moving from this slide to actual code is something different, right? If you try to deliver that kind of output from the basic, it may take time. It may take a whole month to understand what's going on here, or we mean by rolling estimation, because you haven't done it yet, right? So, but you did some sort of ARIMA forecasting or vector autoregressions, co-integration model, VCM, MLE, those, because you learn, whether you agree or not, you learned things a lot, but you don't know much about to deliver. So hopefully, you learn this kind of thing, in more detail with your hand, so that you can use those techniques to answer some real questions like that. Okay. So here is another information you can answer. Suppose you are the owner of this company, because you have asset value estimated for each company, right? So you can calculate EWMA correlation. We learned it, right? I asked it in midterm, right? You learned it hard way, right? Okay, EWMA correlation is calculated starting from here to date. Okay. What kind of impression do you have? If you are a member of the board, and if you are given this slide, what is your impression? So correlation, of course, the value of asset, right? Asset value and its correlation over time, right? Appears to be time varying. It's been relatively low to high, right? If you have several companies having very high correlation, what does it tell you? Is it risky or diversified? You saw it. Probably you want to have your subsidiaries, those companies, when one company underperforms, hopefully the other is catching up, making it up. Right? But if correlation is high, go the same way. same direction. It's not diversified. Right? So that's something, I think, if you're a director of the board, probably it should concern you that the position of our group is concentrated. Right? Concentrated. So somehow you need to bring some other company that has lower correlation than that. Right? So, estimation is one thing, but you can bring many interesting stories using this kind of output. Okay. Okay, this is about what I want to say today. Because we are talking about how to be a good researcher, starting from scratch. Let me show you what I am doing these days. So I chose this particular paper. And this is quite decent journal. And it says how to estimate risk and return of non-traded asset. And then the story goes, and then it says methodology. Okay. So you start with some expressions, and you want to minimize this one, and that's your parameters. And then some other equations. And then data. And report some estimate like this one. At the same time, it says they have internet appendix for this paper. So I try to follow it. And it says the derivation of estimation technique is through this logic, through this one, through this one. And then it says they use generalized method of moment estimation to minimize this function. It says they use this particular estimation method. It's not MLE. This is generalized method of moments method, different method. But it has somehow minimizing some function where they use this one with identity weighting matrix, whatever it is. Okay? And then suppose that you are interested in estimating alpha and beta. Okay? What they describe is they use this method with this assumption. In one iteration, they got this one. And to calculate standard deviation of estimated parameters, they said they did bootstrapping. which is odd to me. So I tried to tackle this problem, but I want to make 100% clear about what they did first, right? Probably I read this paper about 100 times because their description is, very different than what I usually do. So I read it. After all, this is the part, methodology part. The right way would be, well, this of non-traded assets expected return is determined by, let's say, CAPM. That's the starting point. And this is the amount you invest. And this is the income you receive out of that investment. Okay. And this part is right there as a discount factor. Okay. So what it says is by investing this amount and collecting this amount over time, this is what you expected to earn. Okay. So if your pricing is correct, then this pricing error has to be 0. The idea is that. So how to make this one? Well, so we call this one as a moment condition. You have one condition, which is expected value of this pricing error has to be 0. That's the starting point of generalized method of moment. Okay, then using actual data, this is true moment condition because you have only limited sample. So this is a sample equivalent. And then GMM estimator is to minimize this function with W as weighting function. But the thing is, you start with W as identity matrix, but when you estimate this one, you can plug in again, and you can calculate this one again. What I mean is, if you calculate that, you can calculate standard deviation, the covariance matrix, and then use this one as W. So you iterate this one. But what previous study did is stopped estimation at this stage, and this one is not computed. But you need that to calculate iterative value for this one and covariance matrix. Okay, using this one. So what I found was the estimate. The starting point was to replicate someone else's method, this one. But when you actually follow the step, okay, then you'll probably find something else. For instance, they said, well, this estimate is okay, but not efficient. So we iterated. But when you iterate things, the value actually change. So they showed this as a final estimate, but there is a other combination that makes this objective function even smaller. Okay. And the authors somehow need to find out how to calculate standard deviation of this one, but they couldn't, so they did something like bootstrapping. But we calculated in this way and that way. So that's something the other researchers didn't do in the previous study. So, the academics, we accumulate things bit by bit. Even though it is the same problem, you could improve in terms of estimation method. You can improve things in terms of, introducing this kind of idea to calculate this one analytically. Bootstrapping requires a lengthy program, but there's a single line closed form. If you have closed form, why not use it? So the lengthy previous paper, the methodology part, is summarized in 2 pages. I think that's better presentation, I think, than previous work. When you write a paper, make your problem, scale down your problem to, let's say, 1/10. And try to go there as fast as you can. So it's kind of, you're doing pilot run first. And see if some of the parameter of your interest is in fact, turns out to be significant. So you can go ahead and tell some story out of this one. Okay? Most of my research assistants, what they do is they think it hard, plan. So next week is the deadline. Now, we have every data collected. We have good logic, okay? And let's put it in. And the deadline approaches. When actually they looked at the final result, not significant. Nowhere to go. Then deadline. How would you do it? Project fails, right? Fails. That's not the way. Try to go as fast as you can to see the minimal things you can produce. So I can show some result about, this type of pricing model appears to be performing better than CAPM, something like that. So I can add more factors that explain this unknown variable. So I could add more columns, more descriptions, but that's matter of time, right? Matter of time. But if you don't have any result, and if you meet deadline tomorrow, then it's a disaster. So when you go out as an intern or when you get a job there, first thing is you try to make your problem scale first and try to go as fast as you can to some point where you can produce some result and can develop your own story. As long as you have that as a bottom line, then others are all decorations. Okay? You can improve it or you can make scale bigger, but that project is already a success. You get the message? So I thought about doing this one. The dandy of this problem is, when you run a regression, you have left-hand side variable and right-hand side variable and estimate things, right? But in this particular problem, you don't observe this one. You don't observe this one. And somehow you need to estimate those numbers. There is an estimate. Yeah. So if you go out there and try to read some of the recent works, there are many interesting econometric papers available. So pick them and try to follow it over winter break. You make you very different person after you replicate someone else's result one by one. Each time you can feel the improvement of yourself. And lots of things can be learned from replicating someone else's work. So, see, I have a list of reference, short list. Summary is not done. Of course, nothing is now complete. But I know that I can build on this one, this pilot result, some fancy graph, doing numbers, method. I don't have any introduction, but I have a co-author. So my co-author, yesterday I asked him to fill this part. 3 pages long. He'll do it. And I'll extend the estimation part over the weekend. And then when I receive introduction, then I spend some time finishing up the paper by writing this conclusion part. That's the way we write paper. So paper doesn't have to be 30 pages long, 50 pages long. It could be compact, but this is the way we write paper. Okay, hopefully that gives you some message. Any questions? We have how many lectures left? 2? Next week, full week, right? And then final week. But Monday, final week, we are not allowed to go, introduce new material, right? So what I said was I'll go over those sample questions for final, right? And then Thursday, 12th, we'll have a final exam, 2:30 here. So we have 2 more lectures next week. Do you have any particular subject you want to bring to this class so we can do that sort of exercise together, or any particular subject you want to see more, or up to me? Okay, then I'll try to bring some more interesting issues, topics next week. Okay, thank you very much.